Welcome, young investors. My name is James Fletcher. I'm a professional portfolio manager, and I'm the founder of Young Investors Society. And in this unit, we're going to learn about the value of a stock. And so in lesson number 1 today, we'll talk about Mr. Market. Our objectives are to explain who Mr. Market is and the role that he plays in the stock market fluctuations. And then we'll learn how to locate stock information and see and understand why stocks go up and down. So to start off with, let's watch a video that talks about my experience when I was at college and how I learned about the swings in the market. Young investors, in this next unit, we're going to explore how to determine what the value of a stock is, one of the most critical questions for any investor. I still remember a day in college when my finance professor brought in a copy of the Wall Street Journal. And he turned to the stock quote section and said, pick any company at random and look at the high and the low of the stock price from the past year. So I randomly picked General Motors, and over the past 52 weeks, their stock price had a high of $40 a share and a low of $15 a share. That meant in just 12 months, the market had estimated that the value of GM as a company was as high as $64 billion and as low as $24 billion, a difference of over $40 billion in value. And then we looked at other companies, and the high volatility was similar. So was the real value of GM changing that much? No. The car business doesn't really change that much year to year. A Chevy Silverado last year is still a Chevy Silverado this year. It's not like they're figuring out how to fly to the moon or replace gasoline with water. It was basically the same business last year as it was this year. So what in the world was going on? When I checked with my classmates, the same thing was happening for the companies that they chose as well. Why was it happening to every single company in the stock market? Was last year an exceptional year of price swings? Nope. Is there something that the market knows that we don't know? Nope. So what's the explanation? I remember my professor leaned in and he smiled and he said 6 simple words I'll never forget. Sometimes the market just goes nuts. Legendary investment teacher Benjamin Graham tells the story of Mr. Market, and you'll learn about it in this unit. It basically paints the market as a pretty moody guy, up one day, down the next. So does this mean that we shouldn't invest in the stock market because of these wild swings up and down? To the contrary. The fact that we are offered deals from time to time should make us very excited. Our goal is to 1, identify what the company is worth, and 2nd, wait for Mr. Market to have a bad day and then buy at a discount. Benjamin Graham calls this giving ourselves a margin of safety, which you'll remember is one of the golden rules from our previous unit. Okay, you're thinking, this is all well and good, wait for the market to go crazy, and then buy below the fair value. However, there's one problem. How can we be sure that we even are close to knowing what the value of a company is? How do we know that our forecasts are even in the ballpark? Aren't there a ton of smart people with computer programs waiting to scoop up bargains as soon as they become available? Surprisingly, not as many as you think. During this unit, we'll go over why the market goes up and down and begin to explore various ways to calculate the true value of a company. Enjoy, and remember, sometimes the market just goes nuts, but that's where the opportunities are found. Okay, welcome back, young investors. I have with me a box of chocolates, and we can play a donut activity or a chocolate activity. The example is the same, but let's assume these are great Ritter Sport chocolates. How much would you pay for one chocolate? So maybe 50 cents, maybe 25 cents, maybe $1. These are high quality chocolates. Would you pay more for one than the other? Let's say some are caramel flavor, some are nut flavor. If you happen to be allergic to nuts, would you pay more or less? You would pay less, of course. Let's assume that there's a sugar shortage and there is no more sugar or no more chocolate in the world. And this box right here is the last box of chocolates in the world. how much do you think you would pay for this? How much do you think these would go for at auction? Probably thousands of dollars or even $1 million. And so what do we learn about that? The worth of something goes up the shorter supply it is, or the more valuable that it's perceived. What about if I had just eaten a huge chocolate bar and I had just eaten a whole box of these, and then someone asks me, do you want more? How much would you pay for it? I would probably give a very small answer, because I'm just not interested in chocolates. I just don't have much desire anymore because I just ate a big box of donuts or chocolates. And so the value of something, the perceived value, is the scarcity and your desire for that good. And it's not just your desire, it's the desire of the marketplace. Let's substitute now the donuts for a company. And a company or a stock works the same way. What would you do to maximize the value of chocolate? Or what would you do to maximize the value of a company? You would make it more scarce, more valuable, and what would you do when the value of this company goes down? You would want to buy more. What would you do when the perceived value goes up? You would be hesitant to buy more. So enjoy your donuts or chocolate, and let's watch a video from the Oracle of Omaha himself, Warren Buffett, talking about how he looks at the stock market when it goes up and down.
Well, I've got no idea where the market's going to go. I prefer it going down, but I have, my preferences have nothing to do with it. The market knows nothing about my feelings. That's one of the first things you have to learn with a stock. You buy 100 shares of General Motors. Now, all of a sudden, you have this feeling about General Motors. I mean, if it goes down, you may be mad at it. You may say, well, if it just go up to what I paid for it, my life will be wonderful again. Or if it goes up, you may say how smart you were and how you and General Motors have this love affair and everything. You've got all these feelings. Stock doesn't know you own it. Stock just sits there. It doesn't care what you paid. It doesn't care that you owned it or anything. So any feeling I have about the market is not reciprocated. I mean, it is the ultimate. It is very cold shoulder we're talking about here. And anybody that is going to be a net saver, practically everybody in this room is more likely to be a net buyer of stocks over the next 10 years than they are a net seller. So every one of you should prefer lower prices. I mean, if you're going to be a net eater of hamburger in the next 10 years, you want hamburger to go down unless you're a cattle producer. And if you're going to be a buyer of Coca-Cola and you don't own Coke stock, you hope the price of Coke goes down. I mean, you're looking for it to be on sale this weekend at your supermarket. You want it to be down on the weekends, not up on the weekends when you're going to attend the supermarket. Your stock exchange is a big supermarket of companies, and you're going to be buying stocks. What do you want to have happen? You want those stocks to go down, way down. And, you will make better buys then. And later on, 20 years from now, 30 years from now, when you're in a period when you're dis-saving or when your heirs dis-save for you, after you're gone, I mean, then you may care about higher prices. But I find people, that was one of the, there's a chapter 8 in Ben Graham's Intelligent Investor about the attitude towards stock market fluctuations. And that and the chapter 20 on the margin of safety are the two most important essays ever written on investing as far as I'm concerned. Because when I read chapter 8, when I was 19, I figured, I just figured out what I just said, but it's obvious. I didn't figure it out myself, though. It was explained to me, and I'd probably gone another 100 years if I had read it and still thought it was good when my stocks were going up. Now, we want things to go down, but I have no idea what the stock market's going to do. I never do. I never will. It's not something that I think about at all. When it goes down, I look harder at what I might buy that day. Because I know there's more likely to be some merchandise there that I can use my money effectively in.
Okay, welcome back. So a couple of questions to discuss. What do you do when the market goes down? Warren Buffett says that if you caught it, he said, I like it when the markets go down. So why is that? It's because for him, things are on sale. He's able to buy quality merchandise at a discount price. So who wouldn't want this? Think about Warren Buffett's approach. Do you agree with this approach? Is it wise to buy when the company's value is down? I love how Warren Buffett talks about how the market doesn't care what you think. He doesn't care about your feelings. He doesn't care about what price you paid. The market goes up and down, And our job is to find out what is the value of the stock and can we buy it at a discount. Okay, so let's move on. Let's have an activity and let's go on your computer or your smartphone and let's look up the value of a company. And so go to Yahoo Finance and type in the ticker GM, or you can use AAPL for Apple or any ticker that you want to. And when you find it on Yahoo Finance, find out the 52-week range of that company. In Yahoo Finance, this is found under the key statistics. And look at the high price and the low price of GM during the past 52 weeks, or whichever company that you chose. And multiply that price by the shares outstanding and calculate what is the high value, market value of that company, and what is the low value in the past year. What you'll find out, and go through this exercise because it's helpful to start going through this exercise of finding companies and calculating the market value. The market value of any company is the number of shares times the number of shares outstanding. And when you do, you'll find that companies go up and down in the magnitude of billions of dollars every year. So the value of Apple may be $900 billion one month and maybe $700 billion the next month. That's a difference of $200 billion. Is the value of Apple, the long-term value, really changing that much? No. It's the sentiment, it's the market, it's what we call Mr. Market is going up and down. And as long-term investors, we're able to benefit from these swings back and forth. So we have an activity, handout 2.1, and read through this skit, read through this play, and then we'll come back and discuss some of the discussion questions from Mr. Market and Mrs. Investor. I hope you like it. Okay, welcome back, investors. So I hope you enjoyed that activity. It's exaggerated and fun, but it really is how the market works. And so here in this example, how would you describe Mr. Market? I think we would describe him as moody, volatile, erratic, up one day, down the other, and worried about a lot of things that don't really matter. How would you describe Mrs. Investor? I think we would describe her as patient, long-term, rational, and these are the traits that we would hope that we develop as young investors in line with our 7 golden rules. So what do we learn about this example? We learn that the market swings wildly up and down, and the reality is the markets do. This is exactly how most stocks trade on a year-to-year basis. And what can we do as investors? We can take advantage of these swings up and down and be like Mrs. Investor, the rational, long-term business thinkers. Have you ever gotten a deal on something? Think about a time when you have gotten just a killer deal on a good that you bought. How were you able to get that deal? Maybe your parents or you were able to buy a house because a seller was desperate to sell and they were moving and they needed to sell. I actually bought a used car a couple of years ago because a family was leaving the country and they just needed to sell really quick. And so I was able to get a really good deal on a great car. And so sometimes maybe you walk into a mall and there's a special promotion and you're able to get just a great deal. You're at the right place at the right time. As investors, we are always looking for these deals. So we're looking for how can we buy quality merchandise at a low price. In conclusion, let's do a little activity. If I had $10, how much would you give me? If I give you a $10 bill, how much would you give me in return for that $10? Would you give me $20? Not a chance, right? Would you give 10 $1 bills in exchange for my $10 bill? Yeah, probably. I mean, they're worth about the same, and maybe if you wanted a $10 bill, you would do the trade. But stocks are divided up into small percentages of businesses. What about if I gave you $10 and you gave me $5? Would you take it? Of course you would take it. And Benjamin Graham, one of the famous value investors, talked about buying 50-cent dollars. So the value is $1, but you are able to buy it at 50 cents. And the most successful investors are able to purchase stocks that are worth more than what they really cost. So think about this question as we finish. Do you think Mr. Market is good or bad for investors? The initial impression would be that he's bad, but the reality is Mr. Market is great because every now and again he gives us great deals where we can buy great stocks at discount prices. So go out there and find your 50-cent dollars. All right, young investors, I hope you enjoyed that lesson involving donuts and chocolate and Mr. Market. That's a fun one for us to go through. Let's do some FAQs on this lesson. First question that we receive is, why does the stock market go up and down? So what are the actual mechanisms that causes the share price of GM to go up so much in a year-to-year basis? It's a good question. Remember that the market is what we talked about in Unit 1. The market is a marketplace. It's a compilation of buyers and sellers. And so in the end, it's about people making decisions. And people are people. So people are irrational. They get swept up into the moment. We have FOMO, fear of missing out. And if you know the tech sector is doing really well, and your other funds that you're competing with are investing in tech and making lots of money, it's hard to not feel that fear of missing out and being swept up and following the herd. And so what happens is you tend to have this herd mentality in the market in terms of sentiment, too far up or too far down. And so it leads to these swings of people wanting to pay more or less, just like we did for the donuts, for the chocolate, more or less for good, depending on their viewpoint of the scarcity, the value, the desirability of that asset. So it's all of those behavioral factors playing, and remember that it's people making decisions in the market. Second question we received was, why do people make irrational decisions, and why, if we know about Mr. Market, why does it exist? If it's so common that everyone knows that the market is moody and people make up the market, why doesn't it become more rational over time? You know, it's a good question. So the reality is we know about these principles. We know that the market tends to overreact. We know that we tend to overreact. And yet we still keep making these irrational decisions. I mean, think about in your life when you said, I don't want to do this. Next time I won't repeat this mistake. And then what happens is you get swept up in the moment and you repeat it. And the herd mentality, the peer pressure, living, feeling that either excitement or fear in the moment is often so great that the majority of people get swept up into it. And so even though we know about Mr. Market, we know about long-term values of stocks, we know that there's key rules that lead to stock market success, it's just like Warren Buffett said, investing is simple, but it's not easy. So these are simple principles, but that doesn't mean that they're easy to follow. And human nature often leads us to following the herd. The last question was, does Mr. Market contradict the efficient market hypothesis? Efficient market hypothesis we talked about in Unit 1, which is the view that the market prices everything in reality and that everything that is known is in the market. And so they are on opposite sides. So knowing that the market has these inefficiencies, these behavioral tendencies to go up and down, to follow swings of the market, does contradict the efficient market hypothesis. And I think anyone looking at the values of stock, of any stock over 52 weeks, can see that there are swings and there's sentiment that plays a part in the values of stocks. But the other thing to remember is the value of a stock is trying to extrapolate what the value of this company is, 1 year from now, 5 years from now, 20 years from now. And there's a period of assumptions, there's assumptions and guesses that go into that extrapolation. And so it doesn't mean that all of the information isn't being priced as good as it can in that moment when stocks go up and down. Things may change. That may change the long-term trajectory of the cash flows that you expect for that company or the profits. And so that may impact the value. The problem is we can't fully assess is what is the rational view and what is the sentiment, what is the behavioral, what is the overreaction in the markets. And so our job as rational investors is to keep focused on the long-term intrinsic value and then to be aware that the market is going to swing wildly up and down. A lot of times the market is correct, but sometimes the market overreacts and just gets too moody, like Mr. Market. So I hope that helps answer some of the questions during this unit.